What I'm actually going to teach you in this video took me just over 3 years to master, and if I were to actually knew this sooner, it would just take me so much less time to actually become profitable. Because it is so simple, it is so mechanical, and it's always going to keep your win rate above 80%. So let's just get into it. So as you can see, these are my results for this month so far, which I only traded one day. So this is my last month of trading, which was just above $20,000, which is absolutely amazing. You can of course see if I refresh it, absolutely everything is gonna stay the same. So also another thing, if you want to check out my other channel where I literally post all of my trades, all the trade recaps, live trading sessions, absolutely everything is going to be down there, so you can check it out after this video. So let's actually get into the video. Okay, so the first thing we need to understand is what we want to do with this video, all the goals and everything. So the first goal is for you to understand what actually took me 3+ years to actually master, which is of course the reaction rule. So the second thing is where to correctly wait for the market reaction rule. So basically we cannot just come into the market, take a trade or two, we gotta wait for some stuff to actually form so we can take a profitable trade, because that's how it works in the market. The third thing is how to enter the market and how to exit the market. So by the end of this video, you're going to know absolutely everything from A to Z on what you need to do in the actual live market. Okay, so let's start with some kind of basics. So first of all, what we have in front of us is some kind of market, some kind of structure. And if you're wondering whether you can trade this on forex, futures, options, crypto, yes, you can, because this is the logic of the market. So let's get started with it. So the first thing, we want to of course see some kind of structure in the market. We don't want to see market going like this completely sideways. So we always want to see market either going to the upside or going to the downside. So it's pretty simple. Now what we need to understand in the market, it's a term called liquidity. Like 99% of you guys have heard of it, but I need to explain it to you my way. So my way is going to be the way that I teach it. So the first thing we need, when we have some kind of structure to the upside, let's say exactly like this one right here, what do we need to understand? We need to understand where do people place their stop losses. So a lot of people, a lot of retail traders, who knows what traders, they're going to enter trades whether to the upside, towards the downside. So they're always going to enter some kind of trades. But what we need to understand is their stop loss placement is always going to be at the highs and lows in the market, and at the highs. So it's always going to be very logically placed, either above the highs or below the lows. And that's pretty simple. That's the thing that I wrote here. So what I have here is stop losses. So we can name these stop losses and we can name these stop losses. And you can see the market already swept these stop losses. So stop losses were right here. Market already swept them to make them move to the upside. But now, why is liquidity important to us? Why do we need to know what liquidity is? So in the simple terms, liquidity equals money that is going to be given to banks. So banks, institutions and market makers, basically somebody, all that firms who actually move the market. So what we see on the screen, they actually move because they trade with trillions and trillions of dollars. What they are going to do is they are going to hunt these liquidities. So they are always going to go up and down and sweep highs and lows. So you're always going to see the same patterns in the market. Market is always going to go for some kind of liquidity, and then it's going to go for another liquidity, and it's just going to go from liquidity to liquidity, because in the end liquidity is the fuel of the market. So this is what like 90% of people are going to do. They're going to take some kind of imaginary zone from here, and they are going to place the buy stop right there, or the buy limit. So it doesn't really matter, but what they are going to do is they are going to place the stop loss right here. And all the people who have bought the market, let's say right here when we started pushing to the upside, they are going to place their stop losses right here. What the market is going to do, market is going to go down, break all of their stop losses, stop everybody out, make them lose money. After that, market is very likely going to instantly reject like this, and after market rejects like this, what can we expect from the market? We can expect for the market to hunt the next liquidity. Then we have one more thing. So we have liquidity, which is absolutely the main part. We cannot do any trading without liquidity. The second thing is going to be imbalances in the market. So you can see right here, this is something called imbalance. So when the market is making some kind of moves towards the upside, or towards the downside, it's always going to create some kind of imbalances if the move is strong enough. So you can see this is an imbalance towards the downside, so this area right here, because we have made this hole in between 3 candles, and then we have imbalance here, and then we have another imbalance right here. So you can see this is an imbalance right here. So why is imbalance important to us? Because market is always going to go basically retest and fill imbalances. So we know that down here we came, we swept this liquidity, we retested this imbalance, we respected it. You can see that we actually closed inside of it, not below it like this, and we just respected it overall. So what that means to us, that we have 2 confluences that are going to make us buy the market. So we have liquidity sweep and we have a respect from the imbalance, so we can of course buy the market towards the next liquidity. So right now I didn't even show you how we are going to enter the market, but I'm going to do that actually right now on the real chart examples. Okay, so we are in the actual live markets right now, so we are going to go by steps. The first step is going to be for us to find out what the liquidity is. Then we have this high right here, which was untaken, so we mark out both highs. Then if we look to the lows, we can see that we have this low right here that market just swept. So this is a good thing because we want to see the liquidity get swept. Also this liquidity got swept and all of the liquidity to the downside got actually swept. So the next thing we want to spot is an imbalance. So since we just swept liquidity to the downside, so this liquidity right here, we want to see some kind of move towards the next liquidity, which is one to the upside. So what do? We need to spot all of the imbalances below the liquidity. So this is an imbalance right here. You can see there is a hole in the market. It's pretty clear. Then the next imbalance is this one down here. So let's see what the market is actually going to do. So if we fast forward the market, you can see market just tapped into this imbalance. So what do we do right now is we go to the lower time frame. So let's go to the lower time frame. Okay, so here we are at the lower time frame. So let's right now see what the market is actually do and how we are even gonna enter this trade. So entering a trade is going to be based on the fair value gaps. So I'm gonna move these fair value gaps out of the side, so like this, so it doesn't bother us. What we need to do right now is we need to spot the fair value gaps that were made while we were going towards the downside. So we need to spot the trades that were going towards the downside so we can actually trade to the upside. So it's pretty kind of weird. I like to call it reverse psychology because nobody actually thinks this way, and it's actually pretty smart. So look at this. We have this fair value gap right here, and what all of the people, like I would say 99% of traders, want to see from the market is us coming into a fair value gap, of course entering a trade, going to the other side like this. So that's the normal thinking that people do when they want to enter a trade. They use the fair value gaps for basically retests and to trade from them. So what are we gonna do? Since we want to see a trade towards the upside, as we told, we want to see this liquidity right here getting hit. We want to see a disrespect of this fair value gap. So if I fast forward the market, you can see we have one more sweep to the downside. Let's see what happened right now. Okay, so this is not the disrespect. We want to see market actually close, so close with the body right here. So we want to see this in the market like this. We want to see a body closure above this fair value gap. So let's see what is going to happen. So market just wicked like this above. Let's see what is going to happen right now, and there it is. So actually this is what we want to see. We want to see market actually close, so actually close with the body above this fair value gap. So if I put my long position right here, so we entered the trade right here, we put our stop loss below the body like this. I don't like to put it like this because it's way too tight and it's like 15 points in the market. I like to put it like this, wider. You can always put it under the body or under the wick like this. It's not really important. It's always going to be like very similar, but it's just up to you. I always put it down there. So what we are going to target is either some logical liquidity on the way like these ones, or we are going to target the whole move to the upside. So let's actually see what the market is going to do and if it's going to play out to our favor. So let's see. Looks like the market is going good, and there it is. The full TP actually got hit, which is 2.65 risk to reward. Now I always like to say it, if you have a $100,000 account, which is basically a funded account. They can be purchased for like $100, and if you pass it, this would be actually 2.75%, which is $2,650. So just insane profits that you can actually make. But right now let's go over the second example that is gonna be a little bit more complicated. Alright, so here is the second example. So the first thing we instantly see is these highs and lows like this, so we want to mark them out. But before that, if you guys like the video till now, if you found it like helpful us in some way, make sure to leave a like, question anything you want, and of course subscribe to the channel so you always get the newest videos. And actually one more thing, if you want to get mentored by me, if you want to have that chance, you can go down there to the description and you can book a call where we will basically see if you're a right fit for the mentorship. So if you want to have a chance in that, go down there and book the call. So let's see right now what we have on the chart. So as I told you guys, we have some kind of structure to the upside. So what we are going to do is we are going to mark out highs and lows. So we have of course already taken high right here, which I don't really care about. Then we have this low down here, and we maybe have this low down here. So if you want to take a trade, we want to see at least this low get swept. So the second thing that I want to see is we have this fair value gap, and for the downside we don't have any fair value gap, so only trades towards the upside are possible at the moment. So let's see, we are right now in the fair value gap, but we can also retest this fair value gap down here, or even this fair value gap down here. So we have loads of fair value gaps to react from. You can see that market actually went to the downside and perfectly respected this fair value gap, so we pulled back and closed in it. So if I go to the lower time frame right now, to the time of the sweep, so right here when we actually swept the liquidity, I'm actually going to move this out of the way so it doesn't confuse us. So what is the problem right now? So the closest fair value gap in the market on the 1 minute chart is actually this one up here. So if I want to enter a trade, I have to wait for the market to basically come up all the way here and then enter a trade from here to target maybe like negative risk to reward like this, which isn't good at all. So what am I gonna do is I'm gonna actually go to the higher time frame to see if there is a more clear fair value gap. So if I go to the 2 minute time frame, so we actually have a fair value gap right here. It's a little bit smaller but still very valid. So what I'm gonna do actually is wait for the 2 minute time frame to inverse this fair value gap, and then I'm gonna enter a trade. So let's see if that's gonna happen. So we are very close to inversing it, so it's still rejecting. Let's see what is gonna happen. Okay, and it looks like the market, yep, and there it is. So this is the inversion of the market right now. So what do? We target of course this high up here, and with the stop loss, as I told you guys, it's always at the body or at the wick of the candlestick, and never if the body or the wick is inside of this fair value gap, then it has to be at the bottom of the fair value gap. So we can put it below the wick like this, and of course target this high up here, which would be huge risk to reward, more than 5 risk to reward, which is absolutely insane. So let's see how is it actually going to play out towards the upside. So for right now it's going pretty decent, and there it is actually hitting the full TP for more than 5 risk to reward, which you already know guys is more than $5,000 on a single $100,000 funded account. And guys, just before you actually leave the video, I'm gonna give you something for completely free. So it's gonna be the whole playbook of the strategy that I just showed you, and basically this reaction rule that I just showed you in the market guys. So if you guys want to claim it, go down there to the description and just press the link to claim it. And also if you like the video, you can just subscribe to the channel and you can leave a like. You can ask anything you want, I will answer absolutely anything. And also the thing that I told you, if you want to have chance to get mentored by me, you can go down there and actually apply for a call to see if you're a right fit for the mentorship. So with all of that being said, I hope you guys enjoyed the video, and I'm gonna see you in the next one. Peace.